All right, let's dive right into this explainer. We're going to kick things off by confronting a number that is just sitting right smack in the middle of your financial life. It's a number that dictates so much of your day-to-day reality, and yet it's something we rarely ever discuss openly. Today, we're looking at the structural mechanics of wealth, and to do that, we kind of need to rethink everything we've been taught about how money actually accumulates. Most of us actively avoid this number, don't we? Or if we actually sit down and calculate it, it turns into this secret report card that we use to feel either really good or really bad about ourselves. It becomes this sort of invisible tool for comparison at dinner parties where nobody actually says the number out loud. But viewing your net worth as just a simple score, well, that fundamentally misunderstands how money works. So here is the absolutely crucial point. Your net worth, it's not a score at all. It's actually a threshold system. Crossing these specific financial thresholds doesn't just mean you have more money in the bank. It fundamentally changes your relationship with risk, with time, and with institutions in a totally qualitative way. It's a massive structural shift. And honestly, the reason you might feel like the rules of money keep working against you is simply because you haven't crossed that first major barrier yet. Section 1. Escaping the financial gravity zone. Let's start right at the very beginning here. I want you to think of your financial life like a physics problem. Below a certain net worth, you are essentially stuck in what we can call the gravity zone. And this is a place where the mechanical rules of money are actually designed to work against you. Imagine you've got a $500 balance, right? And a forgotten car registration bill hits your account. You overdrive, you get hit with a $35 fee, drop into the negative, and boom, trigger another fee. Within 48 hours, you have literally lost $70 simply because you had $500 instead of $10,000. The exact same financial event costs someone with a $10,000 buffer absolutely nothing. It proves that poverty at a mechanical level is structurally expensive. Risk is priced in, and well, you're the risk. But the toll isn't just financial, it's deeply, deeply psychological. When you're trapped in this chronic scarcity, you experience what behavioral economists call tunneling. You focus entirely on immediate threats. Will the card decline? How in the world do I pay rent this Friday? This intense, constant pressure dramatically narrows your cognitive bandwidth. It leaves you with almost zero capacity for the very long-term planning that's actually required to build wealth. And what's truly fascinating is the hard data behind that exact feeling. Researchers have actually found that the constant mental load of poverty drops your cognitive capacity by the equivalent of 13 IQ points. Just think about that for a second. That is literally the difference between an average score and a gifted classification on a standardized test, and it is entirely consumed by financial worry. To make good financial decisions, you don't just need money, you absolutely need mental space. And this lack of mental space, it just gets completely compounded by the mathematical trap of the zero-sum month. This happens when your income and your fixed costs are just so incredibly tight that any unexpected expense goes straight onto a credit card at 18 to 24% interest. If you're just making the minimum payments on that, you are essentially renting last month's emergency for years. You simply cannot save your way out of the gravity zone if your margins are structurally too thin to begin with. So that brings us to the very first threshold. And that's a net worth of roughly $25,000. Now, to be clear, this is not a wealth threshold. This is a stability threshold. It might look like an emergency fund, maybe a paid-off car, a small investment account, or honestly a mix of all three. But hitting this number is the precise moment you finally buy back your decision-making bandwidth and stop the system from mechanically working against you month after month. Okay, so how do people actually build this up? Well, they don't escape gravity by just cutting out daily lattes or meal prepping. Those are kind of just decorations. They escape by executing one of three major cash flow mechanisms. They either secure a significant income increase, they make one massive structural change to lower their living costs, or they get a temporary windfall, like a tax refund, and they aggressively protect it to build that buffer. Section 2. Surviving the long middle. All right, so once you have that $25,000 buffer in place, you are officially out of the gravity zone. But you immediately enter this really grueling plateau. This is the space where almost all standard personal finance advice, budget, invest, maximize your 401k, is targeted. And it is a notoriously frustrating place to be. The math of this grind is just honest. If you start with your $25,000 buffer and ambitiously invest $1,000 a month at an 8% return, it takes about 9 years to hit the next major milestone. If you don't add to it, it takes roughly 12 years. That's nearly a decade of agonizingly incremental, linear progress where your daily discipline barely seems to move the needle on a month-to-month basis. And honestly, because it takes so long, it is incredibly treacherous. You basically have to navigate 3 specific traps along the way. First, there's comparison drift. You're making all these visible sacrifices, like skipping vacations, for invisible progress in your portfolio, while your peers seemingly just pass you by. Second, sequence risk. A sudden health crisis or job loss can literally erase years of your progress in an instant. And third, upgrade temptation. Literally every financial institution encourages you to expand your lifestyle and your liabilities the exact moment your income grows. Section 3, the second wealth threshold. Now, if you can actually navigate those traps and survive that long middle, the rules of the game change all over again. And this time, they really start to heavily favor you. The second threshold is a net worth of approximately $250,000. At $250,000, the math fundamentally flips from additive to multiplicative. In a reasonable market year, a portfolio of this size might passively generate $17,000 to $25,000 a year. Think about that. That is the equivalent of several months of active saving, generated without you doing anything at all. You've essentially recruited a financial partner that just works continuously without ever asking for a raise. Hitting this number literally shifts your entire worldview. Below this threshold, you kind of evaluate every decision through this really restrictive cash flow lens. Can I afford this monthly payment? But once you're above it, your perspective totally opens up, and you start looking through an opportunity cost lens. You start asking, okay, what does spending this money cost me in lost compound interest over the next 20 years? You stop thinking about money merely as something that just flows through you, and you start thinking like the wealthy do, as capital to be actively deployed. And somewhat counterintuitively, hitting this threshold finally allows you to play offense. We always kind of think the wealthy are risk-averse because they have more to lose, right? Well, actually, scratch that. The reality is the exact opposite. They take way more calculated risks, starting businesses, negotiating aggressively, because their floor is just so much higher. A failure might cost them some money, sure, but it absolutely won't devastate their lives the way it would for someone stuck down in the gravity zone. Section 4. The invisible architecture of wealth. Let's just zoom out for a quick second and neutrally examine the structural landscape we've been traversing. Because these thresholds, the gravity zone, the long middle, the multiplicative phase, they are not natural laws of physics. They are meticulously designed by policy, tax codes, and financial institutions. Just take a look at how the tax code explicitly favors people above the second threshold. In the US, ordinary income from your labor is often taxed at around 24% for middle-class earners. But long-term capital gains, the profit from the assets you own, are taxed at just 15%. The system is structurally biased to tax your actual labor much more heavily than the money you earn merely by owning things. Which, by the way, perfectly explains why Warren Buffett famously pointed out that his effective tax rate is lower than his secretary's. Furthermore, you've got financial regulations that literally lock the most lucrative investment opportunities behind legally defined wealth barriers. To get access to venture capital, private equity, or hedge funds, you generally must be an accredited investor. And that means you already have a net worth over $1 million or an income over $200,000. The access to these high-yield environments is entirely gate-kept, explicitly rewarding the folks who have already accumulated significant capital. So, understanding all of these hidden mechanics, from the massively expensive gravity zone to the multiplicative math of the second threshold, all the way up to that favorable architecture at the top, it leaves us with a pretty fascinating perspective. As you chart your own financial course and put in the work to cross these thresholds yourself, it leaves us with one final, absolutely essential question to ponder. If the thresholds of wealth are shaped by institutional design, who was the system actually built for? All right, let's jump right into this explainer. Today, we're going to unpack the honest math, the mental shifts, and honestly, the systemic realities behind the journey to financial independence. If you've ever felt like standard financial advice just doesn't map onto your actual life, yeah, you're in exactly the right place. We're taking a magnifying glass to the architecture of wealth. We're going to break down the actual mechanics of the system we all operate in, totally skipping the fluff and just utilizing the clear, structured data presented in our source material. So, here's our roadmap for today. 1. The $1 million threshold. 2. The honest timeline. 3. Systemic headwinds. 4. Mapping the 3 thresholds. And 5. The societal wealth gap. Let's get right to it. The $1 million threshold and the structural shift in financial agency. 1 million. I know, right? You've heard this number literally a million times. It's almost a cliche at this point. And yeah, it's absolutely true that $1 million doesn't buy what it used to, especially if you live in a high cost of living city. But here's the thing, reaching $1 million in liquid invested assets isn't really about purchasing power anymore. It's the exact point where your structural position in the financial world fundamentally flips. At this level, something becomes true that has never been true for you before. Your money can, with a very reasonable probability, sustain itself indefinitely. And the math behind this structural shift? It's all rooted in the 4% rule. This comes from the 1998 Trinity study, which looked at historical market data and found that if you withdraw no more than 4% of your portfolio every year, it acts like this massive, reliable shield. You have an incredibly high probability of making your funds last 30 years or more. So the crucial point is this. 4% of $1 million is $40,000 a year. Now, okay, $40K might not fund a lavish lifestyle of private jets, but it means your baseline survival expenses are covered without you having to actively trade your time for income. That core equation, trading your hours for your survival, is officially severed. The psychological effect of this shift is absolutely profound. Research from places like Princeton and Wharton shows that escaping early financial stress drops the heavy chains of constant anxiety. But hitting this $1 million mark, that produces a totally different kind of change. It's not just relief, it's true liberation from constraint. It's like a whole new world opens up. People start taking jobs just because they're meaningful, or they take big creative risks simply because that financial gun is no longer pointed at their head. It's a massive, real shift in personal agency. Moving on to Section 2, the honest timeline, and the math to get to that third threshold. All right, let's do the honest math here, because so much financial content online gives you these technicalities that are just practically useless. Let's say you're at the second threshold, which is $250,000 in invested assets. If you invest a super disciplined $1,500 every single month with an average 8% return, it still takes about 13 years to hit $1 million. That means the full entire journey from that first threshold of $25,000 all the way to the third threshold of $1 million takes roughly 22 years. This is a massive takeaway, guys. It's most of a career executed with unusual consistency. It is absolutely not some quick 5-year internet side hustle fantasy. Now, sure, you can try to catch a rocket ship to compress that timeline. Securing a massively high income, using highly leveraged real estate, or getting lucky with startup equity. But as our sources point out, those accelerants carry huge concentration and failure risks. Honestly, the boring path, the slow and steady turtle you see here, remains the most reliable route for the vast majority of people, maximizing your income, controlling your costs, and just investing consistently in diversified, low-cost assets. It's just so slow that the internet can't easily monetize it, you know? Okay, Section 3, policies and systemic headwinds. Why the gap is not random. So what's really fascinating about this is realizing that this 22-year gap isn't just some pure law of nature. It's partly a function of policy choices. Take the United States, for example. We have a uniquely expensive higher education system that basically front-loads debt onto people at the exact moment when compound growth would be its absolute most powerful. The average U.S. borrower graduates at age 22 with $37,000 in student debt. And that isn't just a heavy burden to carry around. It effectively delays the start of their entire compound growth curve by a solid 3 to 5 years. And we can neutrally observe that different societies just make different choices about how wide to make this gap. Look at the stark contrast here. Countries with strong social safety nets, things like universal healthcare, affordable housing programs, robust unemployment insurance, they provide a literal net that massively lowers the catastrophic risk of trying to cross these financial thresholds. But in systems lacking those nets, well, a single medical emergency doesn't just make you physically sick, it can send you into a complete financial freefall. Medical debt is actually the leading cause of bankruptcy in the US, and it can erase years of accumulation in the blink of an eye. Let's pivot to Section 4, mapping the 3 thresholds and what the numbers actually reveal. Let's clearly lay out the map of this entire financial journey, because these 3 milestones reveal that the rules of money actually change in really meaningful, qualitative ways at each specific level. Step 1 is $25,000. This is where you finally escape the gravity zone. You gain real cognitive stability because the system stops actively draining you every single month. You're suddenly making decisions from a place of stability, not sheer scarcity. Step 2 is $250,000. Here, compound growth actually becomes a felt partner in your wealth accumulation. Plus, you finally gain access to better financial products and can afford to take calculated risks. And then step 3, that $1 million mark. As we talked about earlier, your time is no longer compelled by financial necessity. The options you have here are genuinely different, in kind, not just in degree. And this right here is exactly why standard financial advice can feel so incredibly frustrating. Notice the contrast here. Telling someone to simply save more kind of treats personal finance like everyone is riding the exact same golden escalator, but they aren't. The whole architecture of wealth makes it so much harder from the bottom, where it literally feels like pushing a massive boulder up a mountain, and significantly easier from the top once those better financial products finally unlock. Now, knowing this isn't an excuse for inaction. Rather, it just gives you a highly accurate map of the terrain you are actually navigating. Finally, Section 5, the societal wealth gap, taking the macro view. Let's zoom out from the individual journey for a second and look at society as a whole. The distribution of net worth paints a very clear picture. These structural advantages we've been talking about, they are absolutely not evenly accessible. Right now, the bottom 50% of Americans hold just about 2.5% of the nation's total wealth. Meanwhile, the top 1% holds roughly 32%. So net worth really isn't just a personal balance sheet number, it's a macro social metric. It reflects a society's actual mechanisms of opportunity. The path to these thresholds is significantly shorter or longer based on factors that are completely outside of your individual effort. Seeing this map clearly is a real game changer for navigating that long middle of your personal journey. That grueling 9 to 15 year stretch between thresholds 1 and 2. It stops you from incorrectly comparing yourself to others who might be facing totally different structural headwinds, or who may be started with completely different systemic advantages. As our source material brilliantly concludes, understanding the world you're actually in, rather than the one you were sold, is always the more useful place to begin. So I'm going to leave you to ponder this final thought from the text. When we look at these mechanics of opportunity, when we see how access expands and time only becomes genuinely free at certain very unevenly distributed thresholds, you have to ask yourself, is a system where the rules change this dramatically based entirely on a number you happen to be born close to or far from? Is that a well-designed system? Is it a stable one? I don't have a clean answer for you on that. But understanding this map is the absolutely essential first step, both for your own personal journey and for how we start thinking about structuring the future. Thanks so much for exploring this with me today.